This is Chuck Carnevale. I'm the Chuck in the Markets of Chuck. You know, throughout the history, entire history of this blog, I've always talked about how important earnings growth and valuation are to the investing process, especially for long-term investors and over the longer run. However, today's blog was titled Even Short Term, It's Not About the Market, because, you know, one of the things that's really disturbed me after yesterday, we had a kind of a drop in the market and everybody's getting freaked out by that. You know, my point is that even in the short run, it's really not about the stock market. And I think we need to quit worrying so much about the stock market. So I'm going to go through a presentation here. This is the S&P 500. I'm going to use a 5.5-year chart here. It's the, you know, last 5 years plus the current year that we're in. And, you know, that gives us about 5.5 years. And if you look at the S&P 500 on 12/31/2008, it was at 903.25. It closed at 923.72 on June 16th. Or excuse me, on June 15th, and that's a 3.58% return. So just in this short run period of time right here, the S&P 500 has been up 3.58% so far this year. Now, from its low of 735, the number would be a little better, but just since the first of the year, we've had a down and then an up. We've already had that kind of volatility. And then if you look at the 5-year record of the S&P, $100,000 over this last, you know, 5.5-year period since 12/31/03 would have grown or shrunk to 83,000. That's losing 3.3% on your money. I'll call that an intermediate to long-term period. So what I'd like to do now is compare that to several examples of companies that, you know, have you know, performed during this exact same time frame, but with remarkably different results. The first is Weatherford International. This is an oil and gas service company. This company at 12/31, its stock price, if I can find it here for you, was $10.82 on 12/31. It closed yesterday at $22.06, and that's a 103.9% rate of return, significantly better than the 3.5% or 3.58% in the S&P. And even over the entire 6-year period, this company would have generated a 17.8% versus only minus 3.3 through the S&P. So intermediately, tremendous outperformance. This company got significantly undervalued, I believe more so than the market. It is in the oil and gas business. And, of course, the recovery is simply it coming back to a more normalized value, which it hasn't got there yet. But we had a 103.9% rate of return in weather. The next example is a small cap example, company called Middleby. This company makes food service equipment. It on 12/31/2008, it was at 27.28. It closed at 48.03. Yesterday's close, that is a 76.1% rate of return versus, again, 3.58 for the market. There's no comparison to what's happened to Middleby Corporation over the last, you know, 6 months or so. You know, it's from January 31st to June 15th that went on in the market. Also, if you compare the, you know, the total return here, the 5.5-year period, 17.2% compounded annual return toward 100,000 to 237 in a market that would have lost 3.3%. No comparison once again. My next example is Akamai. This company's share price on 12/31 was $15.09. It closed yesterday at $22.12. That is a 46.6% rate of return for this extremely high-quality little company with no debt. This company, I like to say, makes the internet work faster. They've got, you know, 40,000 servers all over the United States, and they sell to large companies to make their mission-critical internet applications work better. This company, $100,000, would have grown to over $200,000. That's a 14% rate of return versus minus 3.3 in the intermediate term. But again, just for the year, 46.6% versus 3.58. My next example, Cognizant Technologies, an outsourcing firm, went from $18.06 a share, 12/31, to closing yesterday at $25.81. That's a 42.9% rate of return versus, again, 3.58 for the market. This company's 5-year record has been over 16%. Even at, in each of these examples, I hope you noticed that all of these companies are significantly undervalued here, yet they still dramatically outperformed the market due to, you know, powerful earnings growth. This company's grown at over 36%, and even though it's undervalued, it was so undervalued because of the market that it's recovered much faster than the market has so far this year. Then my last example for today is actually an ADR. It's HDFC Bank Limited. It's one of the larger, better-run Indian banks or banks in India. This company, as you can see, has had tremendous earnings growth. I like this picture because it also shows overvaluation here. When this company was this overvalued back in October of 2007, you can see the price corrected dramatically. But it got down to $71.31, you know, at January 31st, 2008. Just to illustrate some additional volatility, the stock price fell all the way down to, in the 50s, actually got as low as 45.50, and then since, February, it's rallied all the way back to $101.92, which was yesterday's close. Bottom line, this company generated a 42.8% rate of return since the first of the year versus 3.58 for the stock market. This company turned $100,000 into over $300,000. That's a 25% rate of return versus minus 3.3 for the S&P. And I do want you to notice that it outstripped its earnings growth rate, which can be explained by overvaluation, which is why I chose it. The bottom line is here that all the 5 of these examples have numbers and rates of return that are materially different than the stock market. And even in this last 6 months, the question I think that, I want you to ask here and then simultaneously answer is, what did the stock market really have to do with the returns, both in the intermediate terms I showed you here as well as the shorter run of only the last 6 months? And the answer is, it all comes down to earnings and valuation in the individual company you own and not the stock market. So we need to quit worrying so much about the market and continuously try to focus on only what we own. This has been Chuck Carnevale. It's been my pleasure. I thank you all for listening and I look forward to talking to you again tomorrow.